Okay, so Jackson Company. Hopefully these will get a little bit easier as we go along, or at least start to make some sense. So you notice we've got the beginning balances here from our comparative balance sheet, ending balance, we've got our operating, investing, financing section set up, and I've already put in the beginning and ending balances. So now I just kind of go through my process on this, and as I mentioned, you may come up with a way that works better for you. Some people like to just go through and do the accounts in order. That's okay. My brain tends to categorize them into, 3 steps. All right, so I'm going to start with the current assets and see what happened. So cash went from 33 to 24. So that would be a $9,000 decrease in cash, which would be explained by a $9,000 credit in the top section of the worksheet. We know that cash goes down, the change in cash goes down at the very bottom, and so if it is a credit on the top part, it's going to be the opposite down below. Okay, so what happened to receivables? They went up 11,000, 14 to 25, explained by a debit. We know that our current accounts are all operating, so we should put net income in here first so we don't forget. All right, and then we had an increase in accounts receivable. Is that right? Yeah, of 11,000. It's a debit here, so it's going to be a credit down below. It's weird to say down below when it's beside, but you know what I'm talking about. Okay, inventory, also a current account, 25 to 41, so that is a $16,000 increase, so that would be explained by a debit. Go to the operating section because it's one of our current accounts, just tell what happened. Increase in inventory. And it's a debit here, so it would be a credit over here. Okay. Let's see, the next item, equipment is long-term, so I'm going to skip that for the moment and go down to accounts payable. Accounts payable went from 43 to 31. These are your credit balance accounts. So this change would be explained by a $12,000 debit, because 43 minus 12 is 31. Accounts payable, also a current account. We had a decrease in accounts payable. It's a debit here, so it's going to be a credit on the lower part of the worksheet. Income taxes payable, we also assume are a current account. They went from 20 to 24. That would be explained by a credit entry in the top section. And then we would say we had an increase in taxes payable. And it's a credit here, so that would be a debit over here. All right, so now what else is going on? I think that takes care of all of our current accounts. So now my next step would be to look at the additional information and work with that. Net income, 28. All right, we know that net income increases retained earnings, and it goes up here on the lower part of our worksheet. Depreciation expense, they actually give us. Okay, so we've got 8,000 depreciation expense. So we would, that's goes in the operating section because it's an income statement account. They tell us it's 8,000. The corresponding entry would be the accumulated depreciation, a credit of 8,000. Now you foresee, I've got to move this down a little bit. Okay, depreciation expense. Then cash dividends were paid of 23,000. All right, cash dividends decrease retained earnings, so that's a debit there. There is stockholders' equity account, financing section. We just tell what we did. We paid some cash dividends. We made the debit part of the entry here, and so it would be 23,000 credit, which would indicate we paid out the cash. Okay, cash received from equipment sold. Oh, that's going to be confusing. I'm going to skip that for the moment. Additional equipment purchased for cash, 7,000. We can do that. 7,000, we got more equipment. Long-term asset, investing section, we just say we purchased equipment. And the other side of the entry would be a credit here, which makes sense because cash went out. All right, now back to the complicated one. That really didn't postpone it for that long. Cash received for equipment sold, original cost of equipment, and book value. So they give us that information. So what we really have to do here is to recreate the journal entry that must have happened, and then we'll post it more or less as is. So it tells us that, let's see, okay, so we got cash received for equipment sold. So let's see, I'm just going to make a little spot right here to do this, and then I'll erase it. So we got cash of $10,000 for the equipment sold, right? And it says the book value, the original cost of the equipment was $15,000. So we know the equipment's coming off the books at $15,000. Let me move this over a little bit. And so we know that we also are going to have some accumulated depreciation that has to come off here. And we also might have a gain or a loss. But it tells us that the book value is $10,000. So that means that if the book value is $10,000, it would be $15,000 minus the accumulated depreciation would give you the book value of $10,000. So that means the accumulated depreciation must be $5,000. So there's no gain or loss on this transaction. I hope you can see that. Okay, so now what do we do with this? Well, the only adjustment we make to cash is this very first one. But now this cash is coming in as a result of an investing activity involving long-term assets. So this is where we say we sold equipment. We go to our investing section and say we sold some equipment. And what did we get? We got $10,000 cash. And so we're posting, it's a debit, we're going to post it as a debit. The accumulated depreciation that went with that was $5,000, right? And then the equipment comes off the books at $15,000. All right. Get this out of the way and see what happens next. All right, so I think that takes us through all of the additional information. And so now we do our thing where we check to make sure we haven't missed anything. So the 33 minus the 9, that looks okay. These are all set. Oh, and this is where you want to go. 78 plus 7 minus 15, does that give you 70? And that's how you know you've done it right. 24 plus 8 minus 5 should give you the 27. Okay, so accounts payable are okay, taxes, bonds payable and common stock. Common stock's okay, that's the same beginning and end, but we must have issued some bonds that they didn't bother to tell us about. So it went from 10 to 20, so we must have issued 10,000 of bonds payable. Long-term liability, financing activity, we just say we issued bonds. Okay, and it is the credit part of the entry is here, so this would be a debit, which makes sense because we get money when we issue bonds. All right, so now we've checked all of our accounts and we need to add things up. This comes to, I think, 124. This comes to 133. And when we add the change in cash, we should get 133. So I guess the thing to keep in mind with this, the top part of the worksheet is just, we have to sort of explain what happened, and then as a result of that, this is the statement of cash flow effects. Down here, it kind of, the change in cash or the impact on cash kind of falls out so that we can put it together to do the actual cash flow statement. So, and again, I do my totals here. So I would do, all right, I'm going to just go right here. We would start with the total of the net income of 28. We'd go minus this, minus this, minus this, plus this, and we would get total adjustments of negative 27. And so we would have cash provided by operating activities of 1,000. Investing, we go 10 minus 7, we got 3,000. provided by investing activities, and then we go 23 minus 10, so we've got our negative 13 used by financing activities. And when we add that 1,000, the 3,000 minus this, we should get that. Okay, let me know if you have questions.